All right, let's jump right into this explainer. We're looking at how a traditional energy provider is facing what might literally be the ultimate modern challenge. We're talking about Consolidated Edison. You probably know them as Con Ed. For over 2 centuries, I mean literally 200 years, they've been the engine keeping the lights on in the New York metro area. But today, they're not just maintaining those old wires and pipes, they're being asked to completely reinvent them from the ground up. So it begs the question, right? How exactly does a 200-year-old grid actually become 100% clean? That's the central tension we're exploring today. It's this massive balancing act between maintaining historical aging infrastructure while somehow funding an incredibly urgent and seriously expensive green energy mandate. It is just a fascinating case study of legacy meeting the future head-on. Here's our roadmap for this explainer. We're going to start with a utility heavyweight, then look at the clean energy mandate, explore funding the future grid, analyze customer impact and rates, and finally wrap up with dividends and financial stability. Okay, Section 1, a utility heavyweight. Let's explore Con Ed's massive footprint. Over $41 billion. Let that sink in. That was Con Edison's reported end-of-day market cap as of July 25th, 2026. That is an immense financial footprint, especially for a company operating predominantly in just a single state. But, it's exactly this massive scale that gives them the financial gravity required to actually pull off the multi-decade, multi-billion-dollar infrastructure projects we're about to dive into. And when considering where Con Ed sits among its peers, you can see they are this massive, steady player in the utility sector. Sure, they're smaller than absolute giants like Dominion Energy and Exelon, but they easily outsize neighbors like PSG and CMS Energy. Now, why does this context matter? Well, when you're a top-tier utility, the financial markets just treat you differently. You've got great access to capital, absolutely, but you also have an enormous target on your back when it comes to regulatory expectations and state climate goals. Moving on to Section 2, the clean energy mandate, transitioning to a green future. You guys, the sheer ambition of the regulation forcing this historic utility to evolve is just incredible. New York State's climate law is the real catalyst here, strictly mandating a transition to a zero-emission electric grid by 2040. And make no mistake, this isn't just some nice-to-have corporate sustainability goal. It's a strict, legislated mandate. For a grid historically built on fossil fuels, 2040 is basically tomorrow in infrastructure years. It's coming up fast. So the crucial point to understand is that they've built their clean energy commitment on these 5 specific pillars. They aren't just, slapping up some solar panels and calling it a day. They are systematically overhauling their entire business model. They've got to build a grid capable of handling intermittent renewables, empower customers with electrification, fundamentally reimagine their legacy natural gas system, reduce their own operational footprint, and do all of this while partnering with local stakeholders and focusing on disadvantaged communities. It's the whole shebang. To actually hit those lofty targets, they're executing on 3 major physical fronts. First up, developing clean energy hubs that are explicitly designed to integrate the massive amounts of offshore wind coming into New York. Second, committing over $1 billion purely to transmission lines between 2020 and 2030. Think of this as a transmission-first approach. Basically, you have to build the highways before the clean energy cars can even drive on them. And third, they're heavily promoting battery storage to balance out the grid for those days when, the wind just isn't blowing and the sun isn't shining. On top of all that, they're tripling their customer energy efficiency and building electrification program investments. We're talking a massive $2 billion by 2025. This includes some really heavy incentives for customers to lower their energy use and swap out old fossil fuel heating systems. Because at the end of the day, Con Ed realizes that cleaning the grid is only half the battle, right? The other half is fundamentally changing how much power the end user actually consumes. All right, Section 3, funding the future grid, the Financial Balancing Act. $37.7 billion. That staggering number is rating agency Fitch's assumption for Con Ed's capital expenditure just for the 5-year window between 2026 and 2030. Seriously, think about that for a second. We established earlier that their entire market cap is around $41 billion. They are projecting to spend nearly the equivalent of their entire market value just on capital expenditures over 5 years to build out this future grid. That is wild. Yet, despite that absolute mountain of spending, comparing them to key peers shows Fitch still rates Con Ed's credit profile at a stable BBB+. That's stronger or at least on par with peers like Eversource and Avian Grid. Even though Con Ed is basically a one-state utility, which usually implies higher regulatory risk compared to guys operating across multiple states, Fitch actually views their financial profile as stronger, and that's largely thanks to highly constructive regulations and super reliable earnings coming from their transmission assets.
Now, a big part of maintaining that stable credit rating really comes down to one specific metric. Fitch projects Con Ed's funds from operations, or FFO, leverage to average roughly 4.9 times through 2030. Keeping this strictly under 5.0 is absolutely critical for them. If they borrow too much and that number crosses 5.0 on a sustained basis, well, Fitch explicitly notes it could trigger a credit downgrade. And if that happens, all that future borrowing we just talked about gets a whole lot more expensive.
Let's move into Section 4, Customer Impact and Rates. Basically, how the bill is paid. When we actually break down the 2026 to 2028 rate plan, the math for the consumer becomes painfully clear. The regulator allows Con Ed a 9.4% return on equity, which is the profit incentive they need to attract investors. But pay attention to one specific detail in the plan. A huge driver of your electric bill increase isn't just fancy green energy tech. Property taxes actually account for roughly 26% of the revenue increase customers see on their bills. It's a really complex ecosystem where local municipal taxes heavily impact the final utility rate you end up paying. The rate plan also includes these specific mechanisms known as true-ups and reconciliations. Basically, this ensures the company can recover variable costs from things that are entirely outside their control. So if a massive severe storm hits and infrastructure gets wiped out, or if pension costs suddenly fluctuate, or there's a huge spike in late payments, these mechanisms allow Con Ed to adjust and recover those costs over time. It definitely protects the company's financial stability, but it undeniably means the customer is the one ultimately bearing the financial risk of extreme weather and economic downturns. Which brings us to our final part, Section 5, Dividends and Financial Stability, Delivering Investor Payoffs. The data shows this unbroken march of annual dividend increases. It is like clockwork. From $3.10 back in 2021 up to an estimated $3.55 in 2026, Con Ed has consistently bumped up its payout to shareholders year after year. And this really reinforces that traditional, steady appeal of utility stocks, right? Investors buy them for exactly this reason: predictable, slow-growing income, even while the underlying company is going through this chaotic, multi-billion-dollar green overhaul. So you might be wondering, how do they actually balance paying out these investors while simultaneously building the grid of the future? Well, Fitch builds their rating models assuming Con Ed is going to maintain approximately this 60% dividend payout ratio going forward, meaning they pay out 60 cents of every dollar in profit to shareholders as a dividend, and they retain the remaining 40% to reinvest in the company, pay down debt, or, fund that massive $37 billion capex plan we talked about. It is a very delicate equilibrium. And just in case things get a little bumpy along the way, they have this massive ultimate safety net, a $3.5 billion shared bank credit facility. It basically provides the daily liquidity they need to juggle ordinary, day-to-day operations alongside these massive capital projects. Knowing they have access to this much cash on demand, that gives both regulators and credit rating agencies the confidence that Con Ed can weather any short-term financial storms while keeping their eyes fixed on those 2040 goals. All right, that brings us to the end of this explainer. I want to leave you with this final thought. Can traditional utilities actually fund a green revolution without totally short-circuiting ratepayer wallets? As Con Edison marches toward that strict 2040 zero-emission mandate, the ultimate test is going to be balancing the urgent, undeniable needs of the climate with the very real economic reality of the everyday customer, not to mention the financial demands of the market. It's an absolute high-wire act, and for sure, the whole world is watching to see how it plays out in New York. Thanks for joining me.